I bought into COIW, the Round Hill Coin Weekly Pay ETF, with big dreams of passive income, only to watch the share price fall off a cliff. I bought in at an average of over $55, and today is hovering around 18. If your goal is like mine, to make solid dividends without destroying your principal, then this math just doesn't work. So I plan to make a move. I intend to sell COIW and use the proceeds to buy a different ETF. Today, I'm going to break down how COIW failed my portfolio and why a different ETF may meet my needs. And of course, we'll go over my portfolio updates as we do every week. I'm on the hunt for an infinite stream of dividend income, and my plan is to turn $1,000 of Robinhood's money into $1,000 of my money. Nothing I discuss today is financial, legal, or tax advice. You need to do your own research for your investments. I am not a financial professional. Let's get started. Today we'll start with dividends. NVYY paid me 34 cents per share this week, totaling $3.98. That's a 103% annualized yield. As with all of my ultra-high yield ETFs, I suspended the reinvestment portion of the plan. However, I am still taking half of the dividend and investing it into SPY, which for NVYY was $1.99 this week. COIW paid me 25 cents per share, a slight increase from the last couple of weeks, for a total of $1.28. This represents a 68% annualized yield. All the numbers that you see in red are pending reinvestment, and I'm holding these until I pick a new fund. I also received HOOW dividends at about 55 cents per share, which totaled $1.20. This is also about a 68% annualized yield. I now have 3 weeks worth of dividends saved up to be invested in whatever replaces HOOW. SNOY paid me about 7.5 cents per share, which is only about a 34% annualized yield, and this dividend has dropped off dramatically over the past month or two. This dividend only hit my account Friday evening, so I haven't had a chance to reinvest it back into SPY. And speaking of SPY, I did receive a dividend of 53 cents per share for a total of $1.66. This is about a 12% annualized return and is exactly what I'm looking for out of SPY. Here's a look at the account on Robinhood, showing that over the week I lost about 0.6%. My buying power is $9.08, and that's primarily because I have dividends I'm not reinvesting until I pick some new funds. Unfortunately, my margin status dropped below the 5% threshold and changed over from low risk to high risk. PAAA is still functioning as a great anchor, but I continue to bleed money out of these ultra high yield ETFs. Here's the weekly view of NVYY. It was up about 1%, currently trading about $17.76. My cost basis is $26.21. HOOW was up about 2% over the week, currently trading at about $43.41. My cost basis is $67.47. SNOY is trading at $11.33, up a little over 1% this past week. Unfortunately, my average cost is $16.25, as this fund pushes all-time lows. Finally, here's the one-week chart on COIW, trading at about $18.32, down 6% over the week. And my average cost is a whopping $55.19, and my total return is down about 67%. And that's why today we're going to talk about COIW and what I plan to replace it with. This fund is an actively managed ETF, and it aims to deliver weekly distributions and 120% leveraged exposure to Coinbase, ticker COIN, and it does that using total return swaps and coin stock. Here's the prospectus for this ETF, and this first paragraph is really important. The primary investment objective is weekly distributions, and the secondary objective is to provide calendar week returns before fees and expenses that correspond to 1.2 times the calendar week total return of common shares of Coinbase. So remember that their primary objective is weekly distributions. If we scroll down and look at the investment strategies, they're using total swap agreements and common stock to reach that 1.2 times leverage. On the last business day of each calendar week, so generally Friday afternoon, the fund resets its exposure and tries to reach that 120% return from Friday close to the next Friday close. And if we scroll back up, we see an important underlined and bolded statement. The fund does not seek to and will not achieve its secondary investment objective, which is the 120% return, for a period of time other than a calendar week. Their goal is the 120% of each week, not 120% of the month or the year. If they don't meet their target each week, then the differences will compound over time. So how does this translate into the total return over the fund's life? Here's a comparison of COIW and COIN since COIW's founding in February of 2025. Unfortunately, COIN has lost about 16% of its value during that time. 120% of negative 16% is closer to negative 19%. But as you can see, the total return for COIW is negative 27%. So its total return is significantly greater than 120% of COIN's total return. That'd be great if this were positive, but since this is negative, it spells disaster. If we go and look at the price return, you'll see a huge discrepancy, with COIN down about 16% and COI down over 62%. Here's a look at the distributions over the last 12 months, straight from Roundhill's website. As you can see, this has been very erratic. The lowest distribution was about 18 cents per share, and the highest is about $1.34 per share. But as you can see, recently the returns have been drifting downward. And although the annualized yield has remained high, the share price has been dropping, meaning that the amount that I take home every week is getting smaller and smaller. 75% yield on a $55 ETF is a lot different than 75% yield on a $19 ETF. So I've decided to rotate the funds currently invested in COIW into blocks, the Nicholas Crypto Income ETF. Instead of betting on one stock, blocks is a diversified ETF. It has exposure to Bitcoin and Ether, crypto miners, tech giants, and other crypto-related stocks and ETFs. If we take a look at the block's prospectus, we see that the investment objective is very different from COIW. This ETF's primary investment objective is to seek capital appreciation, and the secondary investment objective is to seek current income. Because my capital has eroded so much in my COIW investment, the primary objective in this fund of seeking capital appreciation appealed to me, especially since the fund's dividend yield is higher than 30%. If we take a look at their options overlay, we see they have a lot of option strategies available. Some examples they give are covered calls, credit spreads, diagonal call spreads, cash secured puts, calendar call spreads, and collars. Here are a few more details about BLOX. It's a little bit of a newer fund compared to COIW and has a distribution rate of 36%. And the payout has been pretty stable. If we scroll down and look at some of the distribution details, we can see it's generally around this 12, 13, 14 cents per share. The fund holds about 20 different assets. Here's the top 10. Ironically, it does hold Coinbase, but it's only about 3.4% of the assets. I'm glad to see that it holds the underlying assets instead of synthetic versions. Here's a comparison of the total return between COIW and blocks, starting when blocks first started last June. You'll see there's a huge difference here. Blocks is positive almost 23%, while COIW is negative about 22%. Let's take a look at the performance of the price. Again, the difference is tremendous. Blocks is down about 1/3%, while the COIW price is down about 51.5%. I've gone to totalrealreturns.com to compare these funds a little further. And remember, everything here starts with Blocks' inception date since it's the newer fund. If we take a look at the total return chart, there's a huge difference. COIW in red heading down, while Blocks is well into the positive. This mirrors the total return information we saw on Seeking Alpha. The worst drawdown for COIW was about 35% in November, and we're currently in COIW's worst drawdown, over 56%. Let's combine all of this information into a couple of charts. Here's the basics about the fund strategy, and there are very important distinctions. COIW's primary objective, as we saw in the prospectus, is to pay weekly distributions, whereas Blocks is capital appreciation. And then the Roundhill Fund's secondary objective is the 120% total weekly calendar return. and blocks has a secondary objective of current income. Both of these ETFs I consider to be high risk. We saw that the NAV trend for COIW is down significantly, while blocks has been stable. COIW offers a significantly increased yield, recently being around 50 to 75%, while blocks' yield has been about 36%. And we also saw that the Roundhill Fund's yield is highly erratic, while blocks' is pretty stable. They both pay weekly. They both hold the underlying assets, although COIW is primarily using swaps and only has about 12% coin stock. Blocks does not use leverage, and it offers a lot more diversification. The expense ratios are very similar, and even though Blocks is the newer fund, it has about 4 times the assets under management. If you watch the first 5 episodes of my initial strategy videos, you might remember this slide. My goal was to target yields of 75% or more. I think that the experiment has shown that significant NAV erosion beats high yield, and that's what's destroyed my portfolio. So I'm going to have to break criteria number 1 and accept a much lower yield for some NAV stability, or hopefully NAV growth. Blocks seems to meet the other 4 criteria, so I feel good about this decision. I haven't sold my COIW shares yet, but I hope to next week. And the reason was because of the RSI. I was taking a look at the chart and I noticed that the RSI was right at 30. If you're not familiar with the RSI, it signifies when a security has been overbought or oversold. Once it gets below 30, that indicates that the security has been oversold and it's likely to turn around. And coin is in a similar situation. You can see it's following a similar pattern, and its RSI is about 34. So my hope is that in the upcoming week, the stock price will rebound a bit. And if that happens, I'll be able to recoup a little bit more of my money, and I'll also be able to capture the dividend payout for next week. So here's what the portfolio looks like as a whole. 4 ultra high yield ETFs are down about 41%. If you add back in the value of SPY-I, the portfolio is down about 24%. The COIW and the HOOW, which was formerly Misty position, are fighting it out as to the worst return, both down about 62%. So there you have it. What do you think of my decision to sell off COIW and buy blocks? Let me know in the comments. And if you found this video helpful or entertaining, I'd really appreciate it if you hit the like button and subscribe for future updates. And remember, nothing here is financial, investment, legal, or tax advice. I'm just inviting you along my journey. And if you'd like to learn more about my small account margin strategy, check out the first 5 videos in the series. Good luck hunting those infinite dividends.